We're about to get into it. I'm going to give people a few minutes. If not, this video will definitely be up. A few things. People that have simulated trust. Okay. Persons under trust. Okay. So, even if people don't catch this, you can understand what this is about, right? This is about the local housing standards and utilities. Now, I'm going to explain something about this. Those trusts or that so-called paperwork that I helped a few people set up last year. If you have started to utilize your trust, that's great. If you haven't, you definitely still need to try to understand what you are doing. If you have a small business under your trust, a trust is a small business. It is operating your financial corporation that was set up for you at your birth, right? The birth certificate is a stock certificate that is created by the United States. They have something that is, maybe I should pull it up for you guys. Explain this really quick. Parentage. Parentis portray. Okay. Okay, let me show you guys something real quick. So this is parents' portrayal, right? Just to have a quick understanding. Peace, peace, peace and bliss, peace and bliss. Okay, so you can understand what it is. Okay, it's gonna be real quick explanation. Parents' portrayal in the pure definition. Let me go down a little bit. Show a little bit more. Parents' portrayal is a legal doctrine that allows the state to act as the parent for those who are unable to care for themselves, having you deemed as feeble-minded under the state. The state acts as the parent for the minor, which is a minority. Understand this. The term is Latin for parent of the people. So for parent of the people, the father being the artificial birth certificate that is created, right? All right, this is for educational and entertainment purposes, and these are all facts. That's what I'm showing you. It says protection of the children. Now, the state can intervene in child custody disputes. Now, that's a false pretense. I'm going to show you why in a minute. But understand what parents' portrayal is. All right. It is, once again, right here. It is legal doctrine that allows the state to act as a parent for those who are unable to care for themselves. The term is Latin for parent of the people. So under parent portrayal, this is why the ward has wardship over the individual that does not have a trust. If you have your trust set up, you're letting them know that you are of feeble mind and able to perform of the age of majority. Okay, so understand parents portrayal. So now let's get back. Have an understanding of trust and what the importance of a trust is. The trust allows you, Greetings says, the trust allows you to have the control or take the control from the state because the state has the control of your assets, which is the birth certificate under your stock, which is your name. So they've created a something that is a corporate soul. Actually, let me go to that real quick just so you can see that. I want you guys to really get it. Okay. So they have you because they are the parent, they have you as a corporate soul. The corporate soul is what? A corporate soul is a legal entity that consists of a single person who holds an official position. The person and successors can also be part of a corporate soul. The corporate soul is a separate legal entity. Okay, hold on. Let me go down. The corporate soul is it's a separate legal entity from the person who holds the position, from the person. Keep that in mind. It says from the person. I'm going to show you what a person is. Okay, the corporation soul ensures the property that is used for a religious organization, so on and so forth, like the Bureau of Land Management, statistics, vital records. All these people are under government and religion, so keep that in mind. The corporate soul can hold land. Land, you have birthright to land. And the person who holds the position, holding the position of the person controlling the corporate soul, would be the person that is having it under their trust, right? Convey and to encumber the title to it. You would be able to have the title to it, not owning it because it belongs to the corporation because they created it, but with your trust, you can take control of it because you are the beneficial owner, taking beneficial ownership of the birth certificate, if that makes sense. The corporate soul actually continues to exist even after the person who holds the position is deceased because there is a right to succession. So anything from like your parents, your grandparents, all of their assets under their corporate soul, because no one claimed them, they are under the control of the state. Just last year, my mother's been deceased for 20 something years, and just last year they actually they sold one of her stocks on the market on her birthday, literally. Like literally. That's how it is. Okay, so we understand what the corporate soul is. Okay, so now I want you to understand what a person is. Legal. I'm gonna put legal. Make sure we get the right definition. Okay, now listen. A person, what is a person? A person is a legal person, is a person or an entity that had legal rights and responsibilities and can participate in legal activities. And legal persons can be human or non-human. What is human? We know what human is. That's a monster that is acting in like government, so on and so forth, like Leviathan. If you looked up Leviathan, as I showed you guys before, which is government, the ruler, so on and so forth, or non-human, that would be a trust. A trust, that is a legal person. Trust, a legal person, right? It is an entity. An entity is created. That's a corporation or a trust. A trust is a small corporation. I want that to be very understood. Okay, now let's continue. Now we're going to go back so that you guys have an understanding of how important the trust is. I'm going to show you why it's very important. Now, when you are under the wardship of the state by not having your trust set up, right? What you do is you allow them to have the parent patria over you. They are assuming the role as your guardian. This is why they have you as minute, feeble-minded. You're not capable mentally to handle your own business because you're not aware of what's going on and know what to do or how to handle it, right? If you understand that. So now, when it comes to it, being a ward of the state, to remove yourself from the wardship, when people say, oh, coming out of the status, changing my status, all these different things, this is what they're trying to do. They don't even know what they're doing. Most people, this is why it's so confusing to people. This is why people get so misled, because they don't have the proper information. I'm so sorry. I try to help people, but that's up to a person's mind and their ability to see what is going on, right? So if you don't have the wardship, it is in the hands of the state. Let's make this very clear. Again, if you do not have the wardship, what is the wardship? The wardship would be you having your trust to act as the beneficial owner of the birth certificate and all of the stocks hereinto, the Social Security Trust and all of the stocks hereinto. Okay. Now, if you understand that or not, let's continue on, because I'm done clarifying what a business is, what a person is, and a trust. All the same thing. So now, when it comes to the IRS, right? Here are the standards for what? Local business and self-employed. Local businesses and self-employed. So it tells you here, this is for a small business What will be a small business? You doing a DBA, having your DBA, doing business as what? That all caps name, because that is what? A corporation. Is a corporate soul. So you will get the rights to it through your county to do a DBA, right? Now, you being a small business under that name, operating your trust, right? And its benefits. There's a little bit more entitled to that, but I want to make sure you guys are getting this. So when it comes to it, the small business and self-employed, let me show you the allotments. And I want you to understand why this is showing you this is if you have your trust set up and you're handling your own business and your affairs. Because now you're mentally capable, you're not feeble-minded, and you are able to handle your business. You do not need the state to take care of things for you, right? All right. Now, when it comes to this, listen to this. The IRS collection of financial standards that are intended for use in calculating repayment of delinquent taxes. It says delinquent taxes. What are taxes? What people don't understand is what? Every tax season, you're looking for what? A refund of what? Taxes. So your taxes are a refund that are due to you based off of these standards. Understand that. These standards are effective as of April 22nd, 2024 for the purpose of the Federal Tax Administration. These are the expenses in the information for use in bankruptcy calculation that can be found as well. If a person has filed bankruptcy, they can also use these same calculations. If you don't have a trust set up, you have never done a trust, anything of the sort, then you would be able to still do this if you have filed bankruptcy. Okay, having an understanding of that. Now, understanding this is the utility standards, and we're going to go more into the description on the next page. I'm going to pick just one particular state. We'll start with Alabama. Once you go there, you'll find all the states listed. So we're just going to start with Alabama, out the blue. Peace, framing peace. We're going to start with Alabama. Understand how important this is, guys. I hope you guys are following me, because this is, I'm showing you this because it's tax time. Anybody that has their trust set up, you can file all of these standards. Anyone that has done a bankruptcy, you can file all these standards. So we're going to go over home exemptions as well. There is a home exemption that you can do right when filing your taxes to save you funding as well and get refunds back on these things. Check this out. Here we go. Understand this, right? Now, when it comes to the housing utilities, right? The housing utility standards that are derived from the United States Census Bureau and the American Community Survey and the Bureau of Labor Statistics, and they are provided by the state to the county level. The standard for the participating county and the family size. Listen, now, as I said, this is why you have to have a feeble mind, because they're telling you right out what is going on. And if you don't have a mind that understands, you're not going to see it. Now, it's telling you for small business and self-employed, but it's also telling you it's for housing and utility standards. Now, if it's a small business, what would they have to do with housing, right? What would they have to do with housing if it's for a business? That has nothing to do with housing, right? Okay, now continue on. It says, and a family size. Wait a minute. If we're talking about a business, it should be talking about employees, right? Put a 1 in the chat if y'all following me. Like, seriously, I really want to know if you guys are understanding. I know it's only a few people in here, but I want to make sure this is clear. If you understand that a small business and being self-employed, and then having it in relations to housing and utility costs and a family size, just those 3 things alone, right? We know it would say employment if it was talking about a different type of business, right? We're talking about 501c3s, any of these things. It would be talking about employees, right? It would say employees, right? Or individuals that are employed, right? Or it would say laborers or something of the sort, correct? Put a 1 in the chat if y'all follow me. So now when it says family size, right? We know that it's talking about a trust. It has to be, right? Because we're talking about a family. And we're talking about a small business, and the only small business that runs for the family, under family, would be the trust, right? The beneficiary and the trustee, so on and so forth, right? So let's continue on. So the family size, which includes, here we go, both housing and utilities that are allowed for the taxpayer's primary place of residence. Well, what would make you a taxpayer? Having a trust. because you're paying the taxes so that you can retrieve a refund based off of your trust and its assets. All the things you've done all year, your transactions that you have to file for your home, the transactions you file for your vehicle, all the different things, right? You've been performing this business, right? So it's listen to this again. It says and it includes both housing and utilities that are allowed for the taxpayer's primary place of residence. So residence, we're talking about a residence. We're not talking about a business. Let me check the chat, make sure y'all with me. I want to see some ones. Let's see. Okay. We got somebody that's with us. We got somebody with us. Okay. It must be meant for you, brother. Let's get it. Okay. So now it says generally the number of persons allowed for determining the family size. Now we're talking about family again, should be the same as those allowed as exemptions for the taxpayer's most recent year income tax the income tax and its return. See, as I told you earlier, it's for a return, a tax return. The benefit of filing taxes is to get a return. No one filed taxes to owe taxes unless they're crazy, because we know that taxes are not anything that you have to do. They're voluntary. If you don't understand that, I'll actually show you that. Let's show you that real quick. That taxes are voluntary if you aren't understanding that. Hold on one second. All right, so now let me pull this up. All right, so here, real quick, just to show you, the word voluntary is used in Florida and the IRS publication refers to our system of allowing taxpayers to determine the correct amount of taxes and complete the appropriate returns rather than have the government determine tax for them. So if the government isn't determining my tax, why would they be taking taxes out of my paycheck every week? Oh, because I'm not filing that correctly either. We'll get into that another time. But let's continue. I want you guys to see that. So now let's go on. It says the housing and the housing and utility standards include mortgage, rent, property taxes, interest, insurance, maintenance, repairs, gas, electric, water, heating, garbage collection, residential telephone service, cell phone service, cable television, internet service, and the tables include 5 categories: 1, 2, 3, 4, and 5 of more personal things in the household. I'll show you that as well. Now it says that this taxpayer is allowed the standard amount or the amount actually spent on the housing and utilities, whichever is less. If the amount claimed is more than the total allowed by the household and utility standard, and the taxpayer must provide the documentation to substantiate those expenses that are necessary living expenses. Now, let's check it out. Housing expenses for the family. Oh, okay. So we're talking about a family of 1, 2, 3, 4, or 5. It gives you an additional amount depending on the household size, right? So now, when we go down, we're going to look at the first county as well. So we're in Autauga County. For one person, you're allowed $1,500. Now, this is a monthly expense. This isn't yearly. This is monthly. $1,500 a month for one person household. A household of 2, $1,700. A household of 3, $1,800. A household of 4, $2,000. And a household of 5, $2,100. And that will go the same for each and every state. Let's show you. Let's go to Florida. So in Florida, let's go down. Same thing. See, you would just go pick your state and see, and then you do the calculations, right? So let's go with Bradford County, $1,300 for one, household of 2, $1,600, household of 3, $1,700, household of 4, $1,900, and the household of 5, also $1,900, but $30 more. Okay. So now let's check this out. Okay. All right. So now we're going to also look right here. So when you go up, right, you go to the side over here. Oh, we're still on the wrong. I'm on the wrong page. Hold on. I didn't even go down. I didn't even change the tab back. Sorry about that, guys. Let's show you. Okay. So when you go to, like I said, I'll pick another county. I went to Florida, but let's just do California. So in California, it's the same thing, you know. household 1, 2, 3, 4, and 5. In Alameda County, it is $3,300 a month for one person, $39 for two, $4,000 for three, $4,600 for four, and $4,700 for five person household. This is monthly. So what you would do is calculate this. You would calculate these funds, and then there's a 433F form that you would put and submit that under your trust. With the 1041, not a 1040, because you have to be filed a 1041 if you have trust in the state, not an individual, which is a 1040. You're doing a 1041. Only if you're filing 1041 would this be applicable. Okay. Or if you're filing a 1040 and you have bankruptcy, it would be applicable to you. Okay. So let's go back. To see the other standards. So we'll go back. Okay, so then we'll go here, right? Over here to the right, the related topics, it has the local standards also for your transportation. So the transportation that you would be able to use monthly for the year, the national standard for one car's ownership. If the person doesn't have a vehicle, let's say if they're on the bus, so on and so forth, they have an allowed amount of $214 a month. This is allowable for a person that uses public transportation, the train, buses, so on and so forth. Okay. If you have a vehicle, the national standard is $600 a month. And for two vehicles, it's $1,200 a month. Okay. And when you go, that's the national standard, but the location may vary or different depending upon your region. So you have to go here to check the correct and valid amount. The Northeast region, it's $285 for one car and $570 for two. In Boston, it's $300 and $600 for two. So you see it varies depending on the location. In the Midwest region, they're getting a little lower of amount, so on and so forth. Okay. All right. All right. So that's for a vehicle. That's a monthly allowable expense. So you would calculate that by 12, and this is the amount that you would put on your return. Okay. The same thing with the housing standard, calculated by 12. There's also the standard for your food and clothing. The national standard for food and clothing and other items. Let's go over those items rather quickly. It's a small list. For one person, two persons, three persons, or four persons, and then additional persons are allowed as well. So for food, for one person, you're allowed $458 a month. For two persons, $823, $977. Four persons, $1,143. For household supplies, cleaning supplies, things of that nature, $44 for one, $75, $83, and $82. For clothing, $87 for one person, $157 for two, $187, and $300 for four. Personal care products, toiletries, women's feminine products, so on and so forth, $48, $80 for a household of two, $87 for three, $97 for four, and also miscellaneous products, all other additional needs of things you might need for kids or yourself or what have you. So the total for one person is $808 a month. This is monthly, so you calculate that by 12. If you have a household of two persons, it's $1,400, and you will calculate that by 12. A household of three and four, so if it exceeds four, so if it's a household of five, these needs you can add additional. So if you have a household of five, you'd add an additional $386. And if it's for six, obviously another $386, and you would calculate that by the 12. So let's verify the last one. Also standards for healthcare. So this is the last one. You have out-of-pocket healthcare. If you're paying out-of-pocket healthcare and you're under the age of 65, that's $83 a month. And over the age of 65, $158 a month that you can calculate times 12 to claim that as well. All right. Are you guys getting this? Let me see. Oh, okay. I got a couple of ones. Now I came back to check. All right. Of course, my love. It's definitely my pleasure. They said TikTok is up. I was like, oh, well, I was directed back to YouTube, so I got to get back over here and do what I'm supposed to be doing here, regardless. Okay, now, so are you guys seeing this? Tell me, put a fire emoji, some happy faces, something in the chat if you guys are seeing the benefit of this. If you guys understand why I kept telling you or explaining to you about the trust just on this alone, not to mention everything else that you can claim, like a house a year. Every year you can get a new house. Okay, let's go. This is going to be the next thing that we're going to go over, right? there's something called homestead exemptions. You can also file this through the IRS and getting the application for the homestead exemption. Let me actually try to pull that up too while we go over this. Let me share that with you guys. And then, okay. All right, there we go. All right, so homestead exemption. What is a homestead exemption, you might ask? A homestead exemption is an exemption that removes all or portion of value from your residence homestead as authorized by the state. A homestead exemption also limits the increase of your appraised value by 10% annually, which you don't worry about that because once it's under your trust and you put it under your trust, it is protected. Okay, so that's a whole nother story, but this is just claiming a credit. The homestead cap may exceed 10% increase in additional improvements, so on and so forth, blah, 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 blah. What is a residence homestead? It is owned by, it has to be a person that is owned by the individual or a qualifying trust. See, now if it's under a trust, it's two different things going on here. It says an individual or qualifying trust. So if a person doesn't have a trust, there are other exemptions that qualify. And then if you have a trust, there are more exemptions that qualify, like the ones I just showed you, all those national standards. See how this is important? Designed or adapted for the human residence and is used as a resident. It must be a home, right? Remember I was showing you under there, you know it's a trust because it's telling you a residence and a home. It's not saying the business or employees. It was talking about residents, family, so on and so forth. It is occupied by the owner and their principal as their principal residence. So we know that that's what's going on, right? What do you need to do to apply for this application for the homestead? You have to have a copy of your driver's license or a personal identification number. Driver's license needs to be from Texas. I'm going over Texas exemption just so you guys know, because this is, you have to check the one in your state, but it is under the IRS. I'll show you that as well. The public safety and the address must match the homestead address. So your driver's license, obviously, if that's your residence and you live there, even if it's under trust, you would have that under, even if you don't have a state driver's license, you should have a state ID. Okay. A passport is sufficient. A license to carry the election identification certificate are not acceptable forms of identification. You must have a copy of all specified documents for the types of exemption, so on and so forth. And it's different per area. So we're just now, as I just told you guys, we're looking at Texas. So let's go into the application really quickly. See, it's very simple. It asks you who is the owner. You put your information, name, address, phone number, date of birth, your email address. If you're requesting to change an address or anything, email, you put a check mark there, so on and so forth. Legal description of the address. Whether it's a manufactured home, so on and so forth. Is the owner of the property? Are you guys a married couple, single, individual? All these things are important. They'll ask, but it's very simple. As I stated, 2 pages, I think, of information mostly. It says, are you filling it out for the state tax years in which you are applying for the exemption? Yes, blah, blah, blah. So it's very simple, as you see. I'm not going to read the whole thing, guys, but as you can see, I'm going to move on. As you can see, it's very simple. 1, 2 pages, and 3 is just the information. Like I said, it's just 2 pages of information you have to fill out. Very, very simple. Okay. And then, I'm not even on there. I'm sorry, guys. Let's see. I was about to go to another page. Thought I was on there. Okay, so this is the application. Like I said, it's 2 pages, right? This is Tarrant County. I pulled this up because I'm in Texas. So see, it's 1 page. Like I said, very simple questions. Check mark. You read it, check it if it applies, and check it if it don't. This page is just showing which exemption you're applying for, because there are different exemptions, right? They're different for survivors, so on and so forth. A person would generally, be doing a general residence homestead, right? You may qualify for this exemption if you own the property and you occupy it. That's all you need to do. And it's your principal residence, your home, your main residence, and your spouse does not claim a residence homestead exemption on another property. So you guys can have two or more properties, but you can only claim it on one if you are married. So being single is a benefit. Keep that in mind. We ain't gonna talk about that part, but that's another legal binding thing that they have you with the state, that marriage. You can get married without going through the state. That's a whole nother story. So generally, this is what you would be filling it out for. But if you are a person under these circumstances, you would also be able to use this as a beneficial exemption. 65 years or older, a disabled person, a disabled veteran, a surviving spouse or a disabled veteran who qualified, anyone that is over 55 and a surviving spouse, donated residence homestead partially disabled veteran, if he's partially disabled, surviving spouse of a disabled veteran, and first responder killed while on duty. And then it shows you everything that you need to do. Very simple, very simple. Are you guys following me? Are you guys familiar with the homestead exemption? Okay. And understanding how important that is. I just want you guys to understand how important that is. It is tax time. You need to get everything. If you own your home, you are eligible. If you own the home and you're living in there, you are eligible for that. Okay? If you own your home and you're living there, you are eligible for that exemption. You don't want to miss it. Some exemptions are up to $300,000. Like literally. I'm just like being honest with you. Right? You want to claim that exemption? All right. Let me show you. You're going to use this form right here. 8898. You're going to use the 8898 form. It's a statement for individuals who begin or end a bona fide residence in the U.S. territory. And there's an NR form. Oh, I forgot the name of it. There's an NR form for a trust. This is for a person, if, like I told you, you guys can do this even if you don't have a trust. The homestead exemption. This is even without a trust. You do not have to have a trust. You will use this form. But there's one for trust, and I can't remember the form, but I'll put it on the page. Okay, so this is the form you will use. Okay, comprehende? You guys following me? Oh no, everybody done fell asleep. You definitely want to check this information because I am going to have it up for you guys to take advantage of these benefits because you don't want to lose out on these benefits, like literally. Okay, and let me see. There was something else I wanted to share with you guys. Went over the exemption, the Public Utilities Commission. You guys are familiar with that. I've shown you the rebates on that. And yeah, that's pretty much it, guys. I told you this was going to be very short. I wanted to show you guys where you're going to be able to get these credits, claim this money. If you have your trust, you are like, you can claim everything under those local standards. You're going to calculate it by 12 and you will fill out the 433F like Frank form. Okay. If not, you can still qualify for the homestead residential exemption, and that is with this form, the 8898 form. Look up homestead exemption in your state and then complete these forms so that you are able to get those refunds back and get accredited those things that belong to you. Okay, whether you get it or not, if you didn't get it, it ain't for you. But if you got it, then you're going to be very happy about this video. All right, guys, I'm out of here. Peace, love, and bliss. Until later, I'm out.